Good afternoon. Welcome back to the Economist's Virtual Sustainability Week. Thank you for joining us for our session on stakeholder capitalism. Now, this is a subject which has gained a lot of traction in recent years, and we have a wonderful panel of speakers to elaborate on it. We have Lutfey Siddiqi, who's the Managing Director of CFA Institute and a visiting professor in practice at Lacy Ideas. Peter Bakker, who's the President and Chief Executive of the World Business Council for Sustainable Development. Márcia Balisciano, who's the Chair of the UN Global Compact's UK network and Global Director for Corporate Responsibility at RELX. Peter Lacy, the Chief Responsibility Officer and Global Sustainability Services Lead at Accenture. And Catherine Howarth, who's the Chief Executive of Share Action. Peter B., I would like to start with you. There was a lot of talk and a lot of apparent action, certainly rhetorically, before the COVID-19 pandemic struck in the area of stakeholder capitalism. We had the Business Roundtable in America sign, or members of the Business Roundtable sign a pledge saying that they will take interests of the other than stakeholders into account in the way they manage their business. A lot of companies made some specific pledges to care about more than just shareholder returns. And then the pandemic came, and a lot of companies went into crisis mode. Do you think they were concerned with survival rather than with changing very deeply the way they operate? From your vantage point as the head of an organization which has been promoting this idea and which obviously has a lot of contact in the corporate world, did you see the interest in stakeholder capitalism suddenly dissipate, or by contrast, did COVID-19 actually bring it even more to the fore? I can see it going both ways in theory.
Yeah, thanks, Jan. And I agree with you. When it was Davos, what was that, 2020, I guess, we were all there. Stakeholder capitalism was the main theme. And then a few weeks later, we all went into lockdown. I think in the very first few weeks, companies were all in survival mode, adjusting to the new circumstances. But very quickly, I saw a new agenda emerge. The Building Back Better movement, as many people now call it, basically has stakeholder capitalism or sustainability, whatever word you want to put on it, at the center. In an organization like mine, where we work with 200 global companies on a membership basis, whenever the economy tanks, you're always a bit concerned that memberships are the first thing to go. But we have actually grown membership through the months of COVID. So that's one indicator that sustainability is gotten more into the boardrooms. Secondly, what I saw happen is, some of the major, particularly, I think it was first BP, followed by some of the other oil and gas majors, were coming out with much bolder targets than they had set before COVID. So actually, what I now notice is you see a couple of things. COVID has made the issue of resilience much more important in any company. We were all ill-prepared for the shock that COVID brought to society. And we're all pretty clear that the shocks that climate change or nature loss or inequality may bring could be much bigger than even COVID is. So resilience has become a board topic. Climate change has grown way more important now. The shock that COVID brought, similar shocks coming from climate, companies need to be ready for that. So I think on the whole, sustainability has gained momentum, has really now taken the mainstream in economic thinking. And that is illustrated by things, no doubt, we talk about later, the movements at IFRS, standardization of ESG, TCFD getting traction. So companies have been, and some still are, in survival mode. But on the whole, I would say sustainability and therefore stakeholder capitalism has become way more important.
Thank you. And Peter L., I would like to turn to you now. I mean, you advise companies on this sort of thing and how to think about stakeholder capitalism and how to think about sustainability. Did the sort of question? Well, first of all, would you agree with Peter B. that that interest in this area did not dissipate, and you suddenly got many fewer questions from your corporate clients about this sort of thing, in March, April, May of last year. And if you didn't, if indeed the interest did remain strong, did the sort of areas about which they were asking change? Did, for instance, climate give way to more concern about worker safety and worker well-being, which again you could sort of understand given the nature of this particular crisis?
The first thing I would say is I agree entirely with Peter's point that the first phase was crisis, and I think the crisis was so intense that it was very difficult for people to have any bandwidth to think about more than survival. But I think that dissipated pretty quickly. I think we're talking 2-3 months, and actually I think people moved into thinking exactly as Peter said about resilience. So resilience in business models, resilience in supply chains, resilience in people planning, thinking about how to create a hybrid world of work, both in offices, in physical locations, but also virtually. An example for us at Accenture would have been that in a 2-week period, we put the National Health Service with Microsoft on Teams. 95% of the NHS on Teams in 2 weeks is an unfathomably large change challenge that would normally take, if you like, something like 5 years of typical change management. So there was a really extreme phase at the beginning, which was about resilience, that was about managing a crisis and survival. My second point would be that I think beyond that, what we have seen with our clients, and I would say this is true for Accenture ourselves, is that the COVID crisis has caused deep reflection, I think, amongst people in terms of their values, and has created an even greater imperative around a number of sustainability themes. And you rightly made the point, Peter. I mean, it's broader than simply climate, it's broader than environment. It has, I think, spilled over into social issues. COVID-19 is expected to push an additional somewhere in the region of 85 to 115 million people into extreme poverty, maybe as many as 150 million by 2021. We're not going to see consumption levels come back to 2019 levels until 2022. So I think there's no doubt that there is even more of an imperative to think about a model of capitalism that works for the many, not the few. That's really the sort of subtext to me for stakeholder capitalism, a model that works for the many, not the few, and that is sustainable over generations, which is where we get into the carbon piece. Now, the third piece I would say is, at least I spend a lot of time with CEOs and with boards, as you rightly say, thinking about how to, thinking first of all about what levels of interest there are in sustainability and responsible business, and then how to act on that. And I have seen no decline whatsoever during the pandemic after that crisis phase. We have seen an increase. I think, for example, that's been driven by different factors. China, for example, with its 30-60 goals, to decarbonize 50% of the economy by 2030, 100% of the economy by 2060 is an incredible commitment that's been made in the largest economy in the world from an emissions perspective. Biden administration coming in and immediately saying they were going to rejoin the Paris process and implement TCFD, so driving the reporting, the compulsory reporting of companies on emissions. That side of things, I think, has been big. But don't underestimate the extent to which CEOs have reflected on their own values and have seen colleagues die. I mean, we've seen people dying as a result of the lack of resilience. And that very human element, I think, has made everybody reconsider what the right balance is in capitalism that puts humanity and the planet first. And so I think now we're really into, for most companies, maybe not the majority yet, because I think we're still pushing to get into that mainstream. But for most companies who are already committed, they're doubling down. And the conversation is not whether or why, but what and how.
Speaking of what and how, I'm sort of, maybe I'll turn to Márcia now. You're a representative of a large company whose business was actually hit pretty hard. I mean, RELX has has a big conference arm, which obviously, for reasons that we can all see here, has been battered. So, did your thinking on sustainability and on stakeholder capitalism at least take a pause after March for a few months, or was it always there? I mean, obviously not yours specifically. It's your role to be to push that agenda. But did you notice in the boardroom, for instance, or in the C-suite, that this was something that the powers that be in the company were, for understandable reasons, somewhat less interested in? And then, what was the dynamic of that thinking over the first few months of the pandemic?
Well, it starts for us with how we do what we do every day. So it wasn't a case of this is a bolt-on activity and we need to set it aside because there's something more pressing. It is the way that we approach the business. So we think about our unique contributions to society. And if you look at Read Exhibitions, we really see that about improving the efficiency of markets and fostering communities. And so the colleagues everywhere had to grapple with the challenges that COVID-19 presented, but they moved pretty quickly from a commercial side to think about online delivery of, for example, shows. A really great addition, for example, of Read Medem for the television industry last summer on a virtual basis. But our colleagues also, for example, in Vienna, worked to transition an exhibition space, working with the city there, to be a hospital in like 3 days. But this response to COVID is mirrored in other parts of the business. So, for example, at Elsevier, the science side of our company, we launched free resource centers that made leading edge science available to doctors and policymakers and others that could help them in their response. I had a kind of funny anecdote because I was talking with a colleague in February from the financial services industry, and he was saying to me, well, kind of skeptical about stakeholder capitalism and saying what we really need is to test this theory is a global financial crisis. And lo and behold, we had one. But what I have not seen is any dissipation in terms of the expectations on us as a business to be responsive to all of our stakeholders. And as I say, it's part of the ethos of who we are as a business. And so that has not been limited in any way.
So, Catherine, I would like to ask you now, sort of from the investor perspective, did you see, again, sort of a looking back a little bit over the course of the past year, and especially maybe the first 6 months of the pandemic, was the interest in ESG, which had been building, ahead of March 2020, did you see that slow, or on the contrary, did you see it accelerate? I mean, there's obviously in the tail end of 2020, there's been a huge boom, but sort of early on, what was happening there?
Well, of course, one of the things that happened very, very early in the crisis is there was a big plunge in stock markets, and that gave everyone a very unpleasant shock. But very quickly it emerged that companies with stronger ESG performance were outperforming in that shock, and so that really quickly moved quite a lot of sort of skeptics actually in capital markets to take a stronger focus on ESG. And then that kind of collided with the fact that this is a major long-term trend anyway in the institutional investment sector. So, last year was a really good year for ESG strategies and for ESG thinking. And I kind of want to, just coming back into this whole discussion about stakeholder capitalism, is that it's a fine conversation and it's a very important conversation, but it's not underpinned by anything in law. In law, shareholders still have primacy. And actually, we won't advance the agenda on stakeholder capitalism without shareholders being fully on board. And I was very encouraged by the fact that 2020 proved that they were very much on board, and we saw some really strong acceleration in that long-term trend. Now, during the year, a number of companies said, look, we're not going to be able to pay dividends this year. And actually, that's a real iron test for a lot of shareholders around their attitude in that. And I would say that within the institutional investment community, there was actually a good level of understanding that companies did need to put stakeholders first, to look after staff, and actually to put dividends on hold for a period, which I think is, a real tough test of whether those commitments are for real in the investment sector. I wouldn't go so far as to say, everyone embraced that, and that there are, income-based investment strategies which will be putting a lot of pressure on companies to return to dividend strategies that they had before, and to get back on their feet, and to look after shareholders well. So there will always be these tensions, but I think 2020 proved a good year for the thesis that shareholders are willing to take more seriously the long-term needs of stakeholders and see it as essential to companies' long-term resilience and financial success.
So can I ask you a follow-up on that? So you say that, well, a couple of things. One, you say that that it showed that companies are on board with this, and I wonder, what metric you're using in arriving at that statement. The dividend thing is interesting, but a lot of it was just sort of preserving cash. I mean, they knew they would have to, they have operations to run. So are we able to tease apart? Is there a way to tease apart whether this was a survival strategy, have enough cash to maintain investor confidence in the company, as opposed to, actually divert that cash to someone else? And then, when you look at the last quarter of last year, dividends were being paid left, right, and center by a lot of companies. So how confident are you that the dividend metric is actually telling you something about stakeholder capitalism? And B, what other things are you looking at to suggest that companies are indeed on board?
Okay, so no, I think it's a very good challenge, and that actually, the dividend story could be played a number of ways, and probably, there are definitely a number of different stories underpinning that. And I think not all attitudes in the investment sector are the same or are aligned around the needs of giving real attention to stakeholders. But I think there are other points of evidence as well. So, I have seen a real uptick. Again, this is a long-term trend in, a commitment to responsible ownership strategies, which see pretty intensive dialogue with corporate boards around a range of ESG issues. Let me give you one really live example that ShareAction is involved with. We've been having a conversation with the retail supermarket sector in the UK about the health profile, the nutrition profile of products sold. And, one of the reasons for that is there's this incredibly strong link between obesity and COVID mortality. Yesterday was World Obesity Day, and the countries with a problem around obesity have had much higher mortality rates. And so this is a real issue that matters and is relevant to lives lost. And the supermarket retail sector is shaping everyone's diet every time. And in fact, it's one of the sectors that did relatively well, because, that was one place we were all heavily dependent on supermarkets during the crisis, and they stepped up wonderfully. And we are all very grateful to key workers in the supermarket sector. But today, Tesco has announced, a big commitment in the area of health and nutrition, and that arose because a group of shareholders have filed a resolution to the Tesco AGM and have been pushing this issue. And that was an issue that was really kind of nowhere pre-COVID, to be honest. And it's a good example of shareholders taking an issue that was relevant to the moment, recognizing this was hugely relevant to long-term resilience in society, but also tapped into regulatory trends and consumer trends in favor of more healthy eating. So there's a business case as well. And the result is a real commitment from the UK's largest supermarket, with 27% of market share of grocery in the UK. So I think that's a nice live example of shareholders collaborating to have a dialogue with the board on a stakeholder issue, and seeing some real change come about. So I think there's a number of evidence points, but I'm not going to pretend that this is all a completely straightforward and positive story. I think there's lots of counter trends and eddies within this overall picture.
Thank you. Peter L., I think you wanted to chip in.
I'm going to just pick up on it. I mean, so I think Catherine's entirely right, and your point was well made as well, Peter. But I would just say two things. So I have the responsibility internally for Accenture Sustainability as well as our work with clients. So, S&P 500 business, 500,000 people, $160 billion business, right? And I will say in the last 6 months, we have seen more conversations initiated by capital markets, by investors, by institutions than we've probably seen in the last 5 years. I mean, there is something really going on here in terms of that trend. So to Catherine's point, firstly, to reinforce that, we see that. I think the second thing I would just say quickly is, I mean, I keep this above my head, not as a halo, but as a sort of an aid memoir, the SDGs, not because they are a moral obligation, which I probably believe they are, but because they are the greatest codified innovation roadmap that has ever been produced by humanity. Right? The United Nations, but also Bank of America's analysis is that we will need to spend $6 trillion a year, every year, to 2030. 60 trillion to deliver the SDGs. So when investors, to Catherine's point, are thinking about this, it isn't simply from a responsibility perspective. This is new markets, new products, new services, investment in infrastructure, totally rethinking transportation, energy systems, the way in which we think about agriculture. So this is also investors tapping into those enormous growth plays that the right companies are placed to take advantage of. So I just thought, just like build on that point, but make the point. Investors, I think, are just switching on to the fact this is just the most incredible innovation roadmap that's been set out.
Can I just ask you a follow-up on that? I mean, that's interesting, and I absolutely agree that it offers an incredible opportunity. But how is that stakeholder capitalism as opposed to good red-blooded shareholder capitalism, where you see prospective markets and high returns?
Yeah, well, look, I think it's both. I think we're actually getting beyond the point where it's worth talking about shareholder and stakeholder, right? Smart business actually is in the top right-hand corner, right? Us consultants, we love our 2x2s, right? Stakeholder value, shareholder value. Where's the smart money? It's always in the top right-hand corner. So I have no problem whatsoever with delivering superior shareholder returns and superior stakeholder returns at exactly the same time. So if you have the products, the services that you can pivot to things like renewable energy, distributed energy systems, electric vehicles, electrification of transport systems, applying digital technologies like artificial intelligence to transport in cities, to reduce emissions, to speed up the flow of commerce, but to do that in clean ways. Wonderful. Great for shareholders, great for delivering the SDGs. I think in a way the stakeholder capitalism term is an outdated concept, or I hope it will be, because I hope those two things become completely synonymous. They aren't for now, as Catherine rightly points out, right? But on the journey, I hope it just becomes capitalism, right? That it's embedded and interwoven. And I think that's what we're starting to see. Because one point I would make on that, Jan, is we are rewiring the world for data and performance, right? So at the GDP level, it's no longer GDP, it's GDP plus your performance against the SDGs. At the company level, we're starting to see greater scrutiny on reporting, but also internal measurement. For example, very concretely, we launched a partnership recently, one with SAP, with SDG Ambition, one with Salesforce around their measurement of carbon, energy, water waste, etc., and into the sustainability issues that the WEF and folks like Peter at WBCSD have been looking at, how you incorporate this into measurement and management, right down to the individual in procurement making decisions about price, quality, but now increasingly sustainability. So we're rewiring the global economy from top to bottom to be able to have almost a double helix of shareholder value, stakeholder value, all the way from top to bottom. So I think it's becoming an outdated concept. I hope it becomes totally outdated and it just becomes capitalism.
I will come back to that, but I would like to bring Lutfey in at this point, because you mentioned basically standardization was mentioned a couple of times, and as how do investors decide which company is actually doing well on this? How do you? There is a proliferation of standards. Companies are self-reporting a lot of it. The one problem I have with the SDGs, of which there are sort of 165 sub-targets, is that any company can find a handful where they're already making progress without changing absolutely anything, and say these are the ones we'll target, and here we go, we're wonderful and sustainable. So how do you look at as an investor, what do you look at if you're looking to back companies that are doing, inverted commas, well on ESG?
Right. Thank you, Jan. So it's clearly something that we need to watch out for. Tokenism, greenwashing, SDG washing, if people might want to call it. And there's two things to watch out for over there. The expectation is one of proportionality and one of pre-commitment. So if you're $1 billion company and you wish to be patted on the back for $1 million commitment, if you're a $100 billion company and wish to be patted on the back for $1 million announcement, that's probably not going to happen anymore. And at the same time, there needs to be some pre-commitment to your disclosure, your reporting measures. Standardized templates is a bigger challenge, but even if you don't want to use a standardized template, use your own template, but that's got to be consistent over time. You can't switch between an Instagram post one day and something else the other day. So it's got to be standardized, obviously. But I think we're making huge progress over there. We shouldn't forget that there's a bandwagon in train when it comes to stakeholder capitalism, but also there's a circling of the wagons from all sides. You saw the UK budget this week, the Green Gilts announcement, for example, which thanks to consultation with the likes of the London School of Economics, the Impact Institute, and others, I think the debate is no longer about the why of stakeholder capitalism or even ESG. It's about the how. The CFA Institute, its recent report, based on a study conducted just a few months ago with our members, the future of sustainability and investment management, it shows that 85% of our members now take E, S, or G factors into consideration. It's gone up. But there are two gaps that need to be borne in mind. One is on the issue of standards that you just mentioned, and the other is on the issue of skills. So 76% of institutional investors say that they would like to invest in products that incorporate ESG factors, but only 19% of them say they actually do. And it's the lack of standards that is an issue there. And the other is, from a skills point of view, if you look at LinkedIn, there's some 6% of vacancies that require sustainability-related skills right now, but less than 1% of investment professionals display those skills on their LinkedIn profile. And in the survey of our members, some 70% of them said that they would like to be trained in ESG, and only 11% said that they think that they are proficient in this area. And on standards, again, the circling of the wagons, there is the SASB, there is the Task Force on Climate Change, TCFD, there's the World Economic Forum, and I know Peter and Accenture are signatories of the metrics over there. And then at the next level of granularity, CFA Institute is developing standards for investment products, so that if you do want to put money into an ESG product, and if it says ESG on the tin, that you're able to assess and compare them across. And there's a detailed consultation process going on right now, and the exposure draft will be out in May. But this is really standards and skills are the two hurdles. But I think the intention is pretty clear to me. I think the why is no longer in dispute. It's the how that we need to help with.
Márcia, you wanted to chip in, I see.
Yeah, I just wanted to pick up the point that you were raising before, Jan, about just picking a set of SDGs and just attaching those to work that you're already doing. I think there's this idea of additionality that has to be factored in what are you going to do that is above and beyond? And something that RELX we have done in 2021 is to align all of our public responsibility objectives to the SDGs, so that we can look at the performance year on year as well as longer term. So a good example from last year, in 2017, we launched a free resource for the world called the RELX SDG Resource Center. It's content from across our business as well as from key partners, for example, within the UN system. And we said that we should use those unique contributions that we have. We're about data analytics. And so we launched an SDG graphic, as we call it, for every SDG, looking at the state of knowledge underpinning this agenda. So Peter pointed out, Peter L., it's going to cost a lot of money, but we also need to make sure that science and research is meeting that. And so one of the findings out of 4 million publications that were produced that linked to the SDGs over a 5-year period that ended in 2019 is that less than 2% of that output come from low-income locations. So that's a citable statistic, but we in our company also need to be aware of how we can address that issue. How can we bring researchers, like programs that we have called Research Without Borders, to increase the amount of, for example, Indigenous African research, because those are the individuals and the hospitals and the libraries and universities that are on the forefront of those challenges. So I think it's about, companies looking at that additionality piece, how can they actually scale their commitment?
Can I ask you a follow-up question? Because the one thing that I always wonder, again, sort of stakeholder capitalism, taking care of your suppliers, of your workers, as well as your owners. It sounds wonderful in theory, but I really do sort of still struggle to understand how you operationalize it. When you're a boss, a CEO of a company, it's already an incredibly difficult job optimizing for one thing, and that is sort of optimizing for shareholder value. It's already an incredibly complex equation. How do you suddenly have to start optimizing? Because in effect, what stakeholder capitalism means is you have to start optimizing for more than one thing. How do you just think about optimizing for more than one thing? It just seems to me that I struggle to see how that works in practice.
Well, I think this is part of the discussion, right? That it doesn't have to be this dichotomy between profit and doing something good for your stakeholders. In fact, what I see and what we see as the benefit of ESG is that this is a way of looking at how a company understands what its risks are and minimizing those risks in its engagement with its stakeholders while looking for the opportunities. So I think that there's a reason, as Catherine said, that baskets of companies that are performing well on ESG are also doing well financially. And in the case of RELX, we, for the last 10 years, have outperformed the FTSE 100, and we are also very highly rated in ESG. That does not mean that we are not on a journey and have a lot of work to do. We do, but I think this is about how investors and other stakeholders can consider the long-term sustainability in the widest sense of that word of a company. They want to know that company is going to be there for the long term because it's considered its risks and it's worked to minimize them, and it's also capitalizing on those opportunities.
So I know that both Peter B. and Lutfey wanted to chip in. Peter B., I think you raise your hand first.
Yeah, no, thanks, Jan. I would say we're now at the stage that sustainability is totally integrated into company processes. We're coming out of an era where we were in CSR, where we were giving back. You had the sustainability department in the corner of the head office. It is now moved into the office of the CFO, of the treasurer. This is all about risk. So what you see happen now, and this is how companies operationalize it, the enterprise risk management systems don't only look anymore at the risks in the balance sheet also look at environmental and social risks. You then move into the decision making. Internal carbon prices are being used when people look at investments. Then we're moving to the space of the disclosures to capital markets, where, as Lutfey was saying, the whole standardization debate of ESG is now raging. And then last but not least, you will go into dialogue with your investors. And what I really expect over the coming years to emerge is that companies that are more sustainable, i.e. have a lower environmental or social risks, will attract lower cost of capitals. And that will become the flywheel through which capitalism actually will be the driver of sustainability.
Lutfey, you wanted to chip in as well.
Yes, on your question about how do you optimize for more than one thing, I think one of the lessons we've learned from the COVID tragedy is that optimizing too much for one factor, cost efficiency, for example, exposed us in terms of reduced resiliency. The issues are multidimensional, multi-order complexity, feedback loops that require multi-stakeholder responses. I think it's the fact that it's a multi-factor world is something that's really been brought into sharp focus, both at the investor level and the investee company level. I just wanted to also say that this has been studied in recent months as to how do you practically, step by step, take it forward inside of a large organization. So the role of intrapreneurs, for example, employees, how can they contribute to that? The role of governance processes and execution processes so that day-to-day activities are linked to the purpose, if it is, of stakeholder considerations. And then lastly, the CFA Institute has a very simple, we call it a rubric. It's a practical questions in 6 areas set of questions. You can go to the website. Any company that sincerely wishes to pursue this, they can do a very quick assessment of themselves. How are we in terms of sustainability training, systems level decision making? Is collaboration part of our operating processes? Can we handle non-standard data? Can we handle higher order risks? Do we have an intentional culture of purpose and engagement? And then it's a very good way to monitor that over time. So a lot of focus on the execution and implementation of it right now.
So I do have a problem with that sort of framing. Just in the sense that
because I think that there's a really important point, and then I think Catherine's got her hand up as well. So I don't think so first of all, the word optimize implies optimizing across different stakeholders. I think we used to live in a world of shareholder value maximization. The whole concept of stakeholder capitalism is optimizing across. And that's why you get paid as a CEO or as a board to make those trade-offs. I'm still absolutely convinced that Jim Collins got it right in Great to Good and Built to Last when he said it's about the beauty of the and the tyranny of the or, right? Poor management maximizes on one axis. Good management optimizes and finds ways to create value on multiple axes. And the second thing I just want to challenge is I do agree completely with Márcia and Peter's focus on risk, but it is only one of the 5 themes that I think matter. Right? Revenue growth, new markets, new products, new services, cost reduction, more efficient use of natural resources, and more motivation of human capital, productivity per employee, risk management for sure, physical risks, reputational risks, brand and innovation, brand and innovation being the 5th, but brand, intangible asset value, which makes up so much shareholder value anyway, but brand in so many different levels. So this is risk, I agree. There's definitely a risk lens, big part of the conversation, but it isn't. And it's not the way we look at it. We look at it as much through the other 4 lenses as we look at it through that. And we have to make tough trade-offs and choices. But really good leadership is not accepting or. It is saying and.
I mean, again, I wanted to say that my problem with that approach is that it seems to me like it's basically maximizing shareholder value under a series of new constraints, as opposed to maximizing or optimizing for a variety of different things. Your guiding principle is still to make profit. You're not suddenly maximizing all these other things as well. It's a long-term profit. It's a sort of long-term greedy approach, which I think the Milton Friedman essay, which just celebrated its 50th birthday, was mostly misinterpreted by Milton Friedman's critics. I think in there's a lot of long-term greedy. I mean, it's basically a long-term greedy manifesto. It's not a short-termist essay. And I think that, you're still making those decisions. And the way that you're framing it is that all these new risks, increasing resilience, that's all in the service. I mean, I don't see how it's in the service of anything else than long-term shareholder value. I mean, that's where I struggle with the whole stakeholder notion a little bit. And I absolutely have no problem, and I completely agree with all of you when you say that you have to take these things into consideration, but you have to take them into consideration in part because they matter for the bottom line more than they used to in the past. Employee well-being matters. Customer reputational issues matter more than they used to. Making sure that you can get hold of natural resources under a changing climate. Those things matter. But are you really optimizing for something else than shareholder value? Peter B, you would like to come in here?
No. So at the moment, the world is preparing for the Food System Summit, the biggest UN meeting around the food system. The key conversation there is, how do we get to the true value of food? So yes, we're optimizing profit, but the definition of profit will change. We're going to have to integrate the externalities environmentally as well as socially into what we consider profit. So the whole concept of stakeholder capitalism is not, here is shareholder and there's a few others. No, we're going to integrate it into metrics, into valuation models, and then we're going to optimize the new definition of value. We call that true value.
That would be really interesting. I mean, that probably, as Catherine mentioned earlier, that would probably require some changes to law, because at the moment, in a lot of places, certainly in America, companies have a fiduciary duty to their shareholders, but not to anybody else. Catherine, you did want to come in earlier as well, I think.
Yes, I just wanted to, I think there's a sort of major outbreak of agreement about this idea that long-term greedy is fine and is where we need to get to, but it's actually a very difficult thing to pull off, because the reality is there's a lot of short-term pressures to achieve results short-term through things which can be at the cost of stakeholders. So the idea that long-term greedy is a problem, it's absolutely where I think we're all aligned, but of course it's execution which is really challenging. And I just wanted to give a kind of practical example which has emerged from work we've done this year through something called the Workforce Disclosure Initiative, which is an investor-led initiative to source comparable information from companies about how they manage their workforce, not just directly employed but supply chain. And actually it's a really interesting area where the data and metrics are very poor and currently very, very weak comparability across companies on this. So if investors really do have conviction about stakeholders, you'd hope that they'd be really engaged with the Workforce Disclosure Initiative. The reality is some of them are, and some of them aren't. But the data that's emerging, and we've looked specifically at how companies were thinking about the workforce in the context of COVID, and it's encouraging to a degree. So a lot of companies did really focus on thinking about employees and their access to, time off work to get sick. Because these are real public health issues where employee responsibility is the right thing. But actually, once you quickly get down into the fact that actually below the employee level, there's much weaker rights for people. And of course, a lot of companies have outsourced a lot of people and a lot of functions. So you're running into some of the real life tricky challenges, which is that there's a kind of in principle engagement with all of this, but in practice, companies haven't all been looking after their real set of people terribly well through the pandemic. And scratch beneath the surface, A, the data is very weak, and B, practice is not always matched up with where the rhetoric is from companies on this. So look, I just want to emphasize that this is really challenging, and that the data isn't always there, to go to Lutfey's point, which is rock solid. But I think investor scrutiny on this and questions with an eye to long-term greedy is where we will need to get to.
Márcia, would you like to give us maybe an example of where you've found it difficult to identify the sort of impacts that companies have that Catherine just mentioned?
Well, Catherine will be pleased to know that we were inaugural member of the Workforce Disclosure Initiative, and we continue to provide our data. And it's challenging to make sure that you have the kind of breadth of information that you would like. But to that particular question, there are a lot of great resources that are out there. And wearing my hat for the UN Global Compact network in the UK and the Global Compact more generally, there's opportunity to learn from peers. I think that's really important. To engage in partnerships. So the Global Compact, for example, has a work stream on decent work in global supply chains, so that you can hear from colleagues about the challenges that they face and how to address some of those. There are challenges. Increasingly, we are being asked to look at how we can achieve net zero commitments. So companies are able to grapple with their scope 1 and scope 2 carbon emissions, which are sort of in their control and in their purview, but it becomes more difficult when you are looking at your wider supply chain. And then it's even more challenging when you look downstream at how people are engaging with your products and services. So being able to rely on those and reach out to these various initiatives can be quite helpful. Another one within the Global Compact is ambition for 1.5 degrees to help companies be able to set science-based targets, again, working with a lot of other entities that are focused on this. So there are real challenges, but I just also want to come back to this question about, whether this is shareholder capitalism just in a different guise or with a different taxonomy. And I would say that, actually, if you ask those other stakeholder groups, they feel very passionate about how they can exercise their votes. So employees, and we see this all the time, that they increasingly want to work for what they perceive to be a good company. So they are exercising their rights as a stakeholder about whether they come to work for you or whether they go to work for somebody else. And for us, we employ about 9,000 technologists in our business. It's a war for talent. And do you want to come and work for us and help to improve health outcomes and advance science and further the rule of law and access to justice, et cetera? Or do you want to go and own a few centimeters on a homepage somewhere? So hopefully, that's a compelling argument. But that's one example. But there are others, and consumers is a good example, as Catherine was saying in the Tesco example.
I would like to come back to one other point that sort of we mentioned in passing, which I would like to maybe interrogate a little bit, and that is, on the performance, on the sort of, in terms of returns of ESG versus better ESG versus worse ESG performers. Lutfey, I'd like to ask you that. Is there actually sort of compelling systematic evidence of a causal link between the two, as opposed to a correlation, where you can sort of see that companies which are already doing well, are also, have the resources basically to do other things? Or is it, can we tell that it's the things that they're doing that are improving performance?
So I think the jury is out. I mean, the data that we do have, and it's not a long time series, so certainly for the last 12 months, the point Catherine made is absolutely correct, that those that are tagged as ESG companies did well from a performance point of view. You could argue that some of them just happen to be platform companies, and therefore with low emissions and things like that, so they sort of fell into that category. But there is growing evidence that over time, this is a fact. The various subcategories. So take a study, for example, that shows the cost of litigation that companies face. Those that rate higher on ESG ratings end up incurring lower potential cost of litigation, which then can be directly mapped to shareholder returns. Those that have taken a longer-term view on climate developments in the climate picture, and therefore took early steps, they did not suffer the kind of downgrading to their stocks when news arrived about certain climate events. So the event risk analysis also seems to suggest that. So I think it's hard to say definitively at this stage, but the direction is very much into demonstrating that. I think we'd make huge progress if we just focused on those that claim to integrate ESG in their decisions, and just make sure that they disclose, ideally in a standardized manner, how is it that they're doing it. And some of the issues that Catherine has highlighted may come out as a result of that. So robust engagement between the money manager and the recipient of the capital on, okay, you've said that you integrate material ESG. Tell us how you have defined material ESG factors and show us how you follow that through. And so I think from a regulatory point of view also, it should be a comply or explain approach, as opposed to saying to everyone, you must integrate ESG. And then the marketplace of ideas, now it looks like, is moving in a certain direction. The one point I should have mentioned earlier when I said 85% of our members are now taking ES or G factors into consideration. The single biggest motivator for that, they say, is client demand.
Peter L., do you want to chip in? We have a few minutes left, so I'll try to get as much.
It's a flawed question on so many levels, because firstly, it's a flawed question because the data has been in for such a long time that at the very least, you take studies that have been done by academics like Mark or Litsky going back a decade that show meta studies of 56,000 academic studies done on the business case, which show that at the very least, there is no downside to investing in sustainability and responsible business, right? Now, and more recently, as Lutfey and Catherine have mentioned, actually, it looks like there is an upside. But here's why it's such a flawed question. As Lutfey just mentioned, there are only 11% of his stakeholders, CFAs, who even know how to value sustainability. So how would it show in shareholder value? I remember having a conversation with the head of the chief investment officer at one of the biggest banks in the world. And he said, my guys simply cannot see outside of the green bays of Excel. If it doesn't fit in their Excel model and they don't know how to quantify it, forget it. It doesn't become part of the valuation. What I will tell you is that at the micro level of the business case, and you made the point, yeah, because you said, look, what flies, what trickles down to the bottom line. I can give you myriad examples of this. Takeda, for example, a company we've just worked with on their journey to cloud, more than 50% reducing the energy that they are using in their IT suite, which is a massive reduction in carbon, but also a massive reduction in cost, with electricity prices going up in key parts of the world. Or whether or not we're talking about things like new markets, new products, new services that folks, I think you ask Philips, 50% of its revenue comes from green products and from green innovation that they've been focused on. So I just think that the whole valuation conversation, the markets haven't caught up. Look, these statistics have just shown us that. So shareholder value, even we've said there's no downside, there's a marginal upside, and people don't even know how to value it. Right? So it's just a flawed conversation in my view. Micro, absolutely, I can give you hundreds of examples of the business case delivering value as well as having sustainability impact.
Peter B., I think we have 1 minute left, so if you could wrap us up, basically.
Yeah. No, I was going to circle back to the beginning of this conversation. The world is in an unprecedented series of challenges. The climate emergency, the loss of nature, inequality. COVID has amplified what a shock to our system can do to our economies. The conversation we're having here today is the defining conversation when it comes to a safe operating space for humanity. This is not about tweaking how we report, how we manage, how we value. This is about the safe operating space for humanity. We are launching Vision 2050 today. The cornerstone in that is reinvention of capitalism. And this conversation, I'm really happy The Economist has put this conversation up. We need more of these conversations. We need way more things to be worked out. But this will define whether we make it or won't make it as humanity. And thanks for organizing this event.
Well, I really couldn't sum it up any better, so I will leave it at that and thank our wonderful panelists. It was a spirited discussion. I'm sure we'll have more of them. Thank you so much, and see you next time.
Thank you.
Thank you.
Thank you.